So here's an interesting case study I received yesterday, and frankly, a pretty common one that we see. So I have a client that has a $700,000 free and clear house, paid off, no debt on it whatsoever. Well, he was interested in the reverse, mainly because he had a lot of money tied up in equity. He was wanting to see different ways that he could use it and access it without creating an additional burden, such as a payment as part of his retirement. Currently, he receives a pension, and his wife is still is working, but obviously that's not going to last forever. So we went through the discussions and talked a little bit about how the reverse would work and gave him some rough numbers. But here on the screen, you can see a little bit of how a reverse would work, and especially the power of the line of credit growth. Now, remember, the line of credit growth increases over time. It has what we call a growth rate. However, if you pull money from that line of credit, then it'll go over to the balance column. So you're either accumulating a balance as far as what you have used or borrowed, or if you have money in the line of credit, you have a growth feature, which that amount increases the access you have to it over time. So what's always pretty powerful is when we take a look at a scenario with a paid off house, especially to see how quickly the line of credit could theoretically grow if it's left untouched. Now, granted, the line of credit's be there to use for whatever purposes or whatever reason. So there's nothing restricting you from, you know, buying or doing certain things with it. The only restrictions there are in the first year, you can only access a portion of it. And then 1 year and 1 day after that, you can access the remaining amount. So looking on the screen here, you can kind of see. So right now, the what we call the expected rate is sitting at 6.76. Now, obviously, the interest rate will fluctuate over time and over the as the years go by. And frankly, this is a pretty conservative number that we have that we're using at this time period. But this is what FHA tells us to use, and so that's what we're going off of for right now. The access to the line of credit this client would have would be roughly about 223,000. And then, if it's not used and allow the growth rate to increase, it's about 17 or $18,000 per year. Now, if we wanted to run a scenario to where, let's say in 5 years, a client needed, I don't know, let's say $50,000 for pick your poison, right? For whatever reason. Well, then we can see here that, we have a disbursement about 50,000. So the line of credit will decrease by, about $50,000. And then they will have access to, or the loan balance, I'm sorry, will jump about $50,000, still giving them access to a pretty good amount of line of credit. And even if we wanted to go further and say, well, here in year 10, we're going to need another $50,000 for, whatever purpose that may be. You could see the loan balance jumped here to about 160, but we still have about $312,000 in that line of credit. So one of the very powerful tools that can be used, the reverse can be used as, is what we call buffer asset. So in times that the market is down, you pull from the reverse mortgage opposed to pulling from your investments. Investments will have down years. It's, going to happen. There will be recessions. Just things happen in the market. And this is a safe, secure, and guaranteed way that you can access funds without giving yourself any additional payment or monthly obligation. Because remember, all you're required to do is pay your taxes, your insurance, your HOA dues, and live in the home as your primary residence. And as long as you do those four things, you're able to stay in that house. So you can no longer permanently occupy it or until you turn 150. So I encourage you, share, tell people about this. There's so many different options about how reverse can be used in tandem with other retirement assets.